Okay, what is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for ticker 4, otherwise known as the company SHIFT4 Payments. So, I found out about this stock a couple weeks ago. I made a small position here, and I like what I see. I'm not saying it's the best opportunity in the world, but based off of all my research, I like what I see here. And if the stock fell more, I would definitely buy some more shares. So, right off the bat, you can see the stock is basically flat for the past 5 years. Okay, keep that in mind. This is a $6.3 billion company, and they basically are just a payment processing company. You know, there's lots of those out there. There's PayPal and there's Block and there's a ton of them out there that do this, but they have a pretty, I like their ambition, I like their growth, and I like the way they're catering towards certain markets where they integrate all different parts of the facility or the location, and they put it all into one software. Okay, so let's look at this company's numbers the last couple of years. Revenue looks good. We see solid growth here going from 1.3 billion to 3.6 billion over the last 4 years. I like that. Net income has been tremendous. Again, this is a big thing I like with stocks. When the stock is flat for 5 years, but the net income has gone from multiple negative quarters to now over $200 million, the stock should be like double what it was back then. So that's what makes me think that I think the stock should be well over $100. I mean, they're doing over $200 million of net income. And what is their, let's see, what's their growth expected to be? We're looking at a huge jump this year, up to $5.2 EPS and then 6.5. Revenue growth of 27% and 24%. Like the numbers are very strong for this company. You look at the PE ratio history, it's basically flat over the last couple of years, but well, I shouldn't say flat because it looks like it's flat, but it has come down a lot. It was in the 60s 2 years ago. Now we're all the way down to 34, which is the lowest it's been, right? So I like that. Yahoo Finance has their forward PE at 11. Again, the cheapest it's been. Just in general, 11 is cheap for any company, but for a company that's doing 27% revenue growth and their EPS is basically doubling for over just a 2 to 3 year period, the stock should be at least 25 times or 35 times earnings. So forward PE of 11 is very cheap. Now, again, one of the things I was concerned about was the competition and like what is their actual moat, which I don't really think there is one. That's the problem. But they're definitely growing. They're growing more than a company like PayPal, right? So they got the growth. They already have a solid business. Let's go back to Qualtrim here. Free cash flow has become way more consistent. I like that. The cash to debt is not great. It's pretty much even, which is okay. I'm okay with that. Shares outstanding is just okay. It's not very consistent. It actually increased at the end of 2024. But overall, like I said, I'm paying only 12 times earnings. So I know there's not much. I feel like this is the worst the stock can do. I guess if their income dropped a lot, maybe then the stock could go down to $50 or something. But really, the forward P of 11 is incredible because it's not like this company is only growing at 1% a year. So that's like what like a Walgreens or a CVS would trade at. This company is expected to almost double. I shouldn't say it's not really a double. It's more like a 70% growth. But 3.8 to 5.2 this year, and then 5.2 to 6.5 next year. Like this stock should be easily $120. So I might buy some more shares here. But yeah, I'm a fan of this stock, and we will see what happens. Thank you for watching, and I will see you in the next video.